All right, let's get started. Welcome everyone to today's webinar, proudly brought to you by ADDX, Asia's largest private markets digital exchange, where we have listed about 40 different private markets products ranging from hedge funds, private equity funds, private REITs, debt, and pre-IPO investments. My name is Cheryl. I'm the head of issuer origination here at ADDX, and I will be your host and moderator for today's webinar entitled Hedge Funds, Unravelling the Mysteries, Myths, and Misconceptions. Today I have with me in the studio Mr. Low Han Seng, who is the Executive Director and Deputy CIO of UOB Asset Management. He also manages UOB's hedge funds, a very successful strategy, and he has been doing that for the last 17 years. Welcome, Han Seng.
Thanks, Cheryl. Thanks for the invitation to join this webinar, as well as a very kind introduction. And a very good evening to all of you for attending this session. Today's presentation we cover 3 areas in the agenda. A very quick introduction on what are hedge funds. And then we'll spend a bit more time on considerations in selecting hedge funds. And then finally, how would investors be able to use hedge funds? The primary objective of this session is to really have a more practical orientation towards hedge funds. So we'll try to keep the presentation a little bit short, and then we'll go to the Q&A so that we can really focus on the issues that matter to you as potential investors. Go forward. So let's start with what are hedge funds? Okay. Hedge funds are part of the alternative investment asset classes. I mean, a rather simplistic way of looking at it is these are assets that are not one of the conventional investments, so not really equity and bonds and cash. They are of interest to us because they tend to have a very low correlation with conventional asset classes, which makes them very good in terms of constructing a portfolio with better risk-return profile. So if you add it to them, you could potentially get a better return for a given level of risk, or get a lower risk for a given level of return. So broadly speaking, within the alternative investment asset classes, there are 3 main types of strategies, right? They are the hedge funds, private equity and venture capital, and real estate, and the respective features of all the funds are really there. We have 4 example strategies of hedge funds, and I will go through that in a little bit of detail later on to give you a better flavor of what is meant by hedge funds, because as an asset class, it is quite a lot of different strategies grouped under one term. One point to highlight really is when you look at the alternative investments, hedge funds is the one that stands out more as having a more defensive quality. And that is because, like for example, in the long-short equities, the managers there can actually be short a market, which is to sell the stock at a given price to buy it back at a lower price. And therefore, there's an opportunity to make money when the stock market goes down. Whereas the rest are just tend to be harvesting a different type of return profile. And this is interesting at this point in time, in particular with the regime change in terms of interest rates, where both the traditional conventional asset classes of equity and bonds have not been performing that well. So something like that would be very helpful in terms of enhancing the return on our overall portfolio. The asset class is not really new. And it has historically been used by more sophisticated and institutional investors. I mean, the endowment funds, the family offices, and even in Singapore institutions. For example, UOB has been investing in these strategies for the last 23 years, and so have the likes of the Temasiks and the GICs. However, recently there has been a greater interest in promoting such asset classes to the less sophisticated investors, primarily because of the appropriateness in the current market conditions, and also because of the good returns they have had. This is a trend towards the democratization of alternatives, and we are very happy to support ADDX as they move this trend and offer such capabilities to their investors. Now let's go on to the next slide, where we look a little bit at the key features, right? And this just very quickly, some of the things that distinguish a hedge fund from a more traditional long-only unit trust fund. So the first thing is that it is very actively managed as opposed to, say, a passive ETF on the other extremity and benchmark tracking funds in the middle. And it's active in the sense that the manager is actually trying to achieve the objective of generating absolute return by managing the risk of a capital loss. So to give an example, right? So generating absolute return and managing the total risk of capital loss. And to give an example of against a unit trust, which is benchmark tracking. So for example, you are investing in a Singapore unit trust, and the benchmark of that unit trust is the STI index. So if let's say, for example, the STI index were to fall by 50%, and that fund manager generated a performance of minus 45%, what would happen would be that the fund manager would think he had done a great job because the manager would have given you a 5% return above the benchmark. However, you might not be that happy because you still lost 45%, right? Whereas for a hedge fund manager, he's there to try to ensure that you don't lose money, right? So he would have a lot of downside measure, and he would obviously not be happy generating a minus 45% return when the index did minus 5. So I think this is the key difference in orientation between an absolute return hedge fund versus a benchmark fund. Now, however, there are also some important considerations. It's not all the benefit. There are also some important considerations that you have to think about that differentiates a hedge funds versus a long-only fund, which is that manager selection is very important, right? If you look at all the managers who are giving you a unit trust focus on Singapore, the dispersion of return is not that large. But in a hedge fund, because of their flexible investment mandate and their broad investment universe, there can be a huge dispersion in returns. For example, if you look at the Eureka Asian Hedge Fund Index, year-to-date performance into July 2022, you would see that it would give you a minus 8.81%. But if you went out there and you happen to be invested in the best performing hedge fund in that whole universe, you would have had a 38.07%. And conversely, if you invested in the worst guy, you would have got minus 49.59%. So you may say the index was giving minus 8.81, but the selection of the manager is very critical in the return that you achieve. So just be mindful of that, right? The second thing is with operational risk management is critical, and I will talk a little bit of detail. That's a little bit different. Many of these hedge funds tend to be small, and therefore it is very important to understand that they are operationally strong. And later on, I will also show you some slides of some of the funds that have failed, not so much on the investment side, but really on the operational side. One final point, which is in terms of the fee structure, there is typically hedge funds charge you a management fee and a performance fee, and that's different from unit trust. And this tends to be balanced out by the fact that the manager typically will also invest their own capital into the fund. So there's this concept of an alignment of interest. The manager gets a share of the upside, but in return, they put their own capital in there and also get exposed to the downside risk. I just wanted to highlight really that hedge funds, sometimes people get fairly excited about it. It's a new thing. They are very nervous about it. But in reality, it is just a new way of managing funds. A lot of the instruments that are being used, equity and bonds, are things that are very common to us. So in a sense, it is a new way of investing a fund rather than using very sophisticated asset classes, because typically they would be using the asset class that we're familiar with, right? Like an equity long short is actually buying and selling of equities. So just to make that point as we go ahead, because sometimes there can be some nervousness around the term hedge funds. So, okay, let's go on to the next. This is the performance. So people say, have hedge funds done well? So I've shown the performance over a long period of time. I've used the Asian Hedge Fund Index and then the equity index. And so you can see very clearly in Asia in particular, the Asian hedge fund indices have performed quite a lot better over the long term versus the equity indices. So you would have made a good return investing in hedge funds in Asia as compared to investing in an Asian ETF. On global hedge funds, well, global equities have had a very, very good run because of the low interest rate environment, and because if the market goes up quite a lot of the time, then obviously a risk control strategy will underperform a little bit. But we can see that it is catching up, and if you look at 2008 during the period of the drawdown, you can see clearly that hedge funds have given you the protection that you want. So it's a bit of return, but really it's a protection against the sharp downturn. Now, if you look at the next slide, where it goes the numbers these numbers reflect a little bit more the benefits that we're talking about. So you look at this, I'm focusing on Asia, right? Look at the hedge fund index versus equity index. Annualized return over almost 21, 22 years, outperformance of almost maybe 3%. Now 3% per annum is over 10 years is 30%, right? That makes a big difference, right? And but more important, and the volatility is almost half. So when you look at Sharpe ratio, which is broadly a measure of returns adjusted for risk, it's about 3 times. So you get the returns at 3 times lower risk, or for the same level of risk, 3 times return. And the key reason for that is really the downside risk management, and the drawdown is about half, right? So this is the kind of benefit that you will get from investing in hedge funds, which over a long term does, as you can see through the chart, translated to significantly more money in your pocket, all right? So maybe let's go to the next one. Now, we have 2 slides here which kind of just very simplistically try to demystify what is these hedge funds and talk about this strategy. And you will see really it is quite something that is quite fundamental and quite easy to understand if you understand some basic finance. First thing is long-short equity. So simplistically, you use a fundamental approach to analyze what is the true value of the company. And then you compare the value of the company versus what the stock price is. If the value of the company is higher than the stock price, you buy the stock and you wait for the price to go up. If the value of the company in your analysis should be lower than the current share price, then you would sell the stock. And when the share price goes down, then you buy it back. So quite simple. So the difference between a long-only unit trust is that you have the ability to sell the stock. So when the market goes down, you can actually sell stocks and buy them back later, and therefore profit even though the stock market has gone down. So that would be equity long-short. Relative value is really you look at 2 stocks and you make the call that the 2 stocks will trade in a divergent manner, right? And you know, there is an underpriced asset and there's an overpriced asset, and the overpriced asset will come down and the underpriced asset will go up, right? So and these typically are sector neutral or country neutral. So simplistically, assuming you know of 2 banks in Singapore and you think that one of them is overpriced and one of them is underpriced, you would buy the stock of the underpriced one and you would sell the stock of the overpriced one, right? And when they came together, then you would profit. But at the same time, you are insulating yourself from the banking sector risk because both are banks, and you are insulating yourself from the Singapore risk. So if Singapore go down, then there won't be a move, but you're just playing the mispricing of the 2 stocks, right? And that would be a relative value trade. Now, the other 2, next page, is event-driven. This is less. There are less funds that does this, but it things like an MMO, an impending M&A. Some of these fund managers have an ability to analyze and say, okay, an M&A has been announced, and they make the analysis that say that based on this M&A announcement, the buyer share price will go up, or the buyer share price will go down, and the seller share price will go up. And then so they make that view and they buy the stock accordingly. And when that pans out as expected, then they make a lot of money, right? And this could be spin-offs and things like that. So it's a particular event and they trade along because they have the ability to analyze that event. And then macro. Macro is just broadly, they trade less in equities, although some of them do, but this is where things like currencies, rates, options, and swap happen. So this is really looking at macroeconomic trends. Like today, for example, right? You said, look, there's an inflationary environment, and because of that, interest rates have to go up, and the US interest rates go up the most, and then therefore the US dollars will appreciate. So you buy the US dollar. So that's it, right? So you look at trends in the macro and the economic, and you express that view, and not necessarily it's a view that is company specific, and those are macro trades. So broadly, these are 4 of the more common strategies, and as and hopefully I've explained that clearly, it's not extremely complex or difficult to understand what these managers are doing. So let's move a little bit forward. So that's broadly a very quick introduction on hedge funds, what they're all about, and hopefully I have given you an understanding what they are, and they're not really very complicated things to understand. Now, I highlighted that one of the challenges of investing in hedge funds is not doing one particular thing, right? If you're investing in unit trust, investing in Singapore, then they're all doing roughly the same thing, right? And they can do a lot of things. They are made, as long as they are trying to achieve an absolute return and they're managing a drawdown risk, they're a hedge fund, right? And they can be invested in a broad range of instruments. So how would we select hedge funds? So let me give you a couple of our thoughts on that one in the next page. So why is this important? So I told you, right, look at this. This is the headlines of some things that can happen to hedge funds that, don't do the right things. Right? So you see billion-dollar nickel swap scandal, crypto geniuses, these are quite close to where we are. In the bottom, our good friends Madoff and some of the things in Europe, right? So if you choose the wrong hedge funds, bad things can happen to you. So it is quite important to do that. But obviously, I mean, just to temper this a little bit, hedge funds is not a don't share too much about the good news. You tend to hear the bad news. Okay, let's go to the next one. Now, I'm sure many of you as investors have a way of evaluating investments. And evaluating hedge funds is just like evaluating a normal investment. Some people look at the track record and say, look, the performance is good, I'll invest in it. Some people say, I like the strategy, I invest in it. And some people just say, look, I'm going to meet the manager and it's a trustworthy guy and he looks like a smart guy and I'm going to invest. The most interesting anecdote I can share with you of a manager, investor looking for fund is that this investor tends to always invite the fund manager and his wife for dinner. And his logic was it is very difficult for the wife to, in front of the wife, if the guy is telling a lie, the wife normally finds it very difficult to keep a straight face. And generally, the guy finds it very difficult to lie in front of his wife. So it's good to do a good question and answer in front of his wife, because through that, you have a very good check. And I have not tried that, but I can see the logic of where that's coming from. My wife obviously finds it very difficult to keep a straight face if I'm not telling the truth. So there are many different ways of doing, but I wanted to just share with you broadly, this is the way that we have been doing it, and this is the way this approach that we have used, and it's been enhanced over the last 20 years that we've invested in hedge funds. This is not the best way, I would say, but I would say that I wanted to just share this with you so you can pick up some points and use some of them in the way that you would invest, you would diligence managers based on your resources and your capabilities. So very broadly, the first one is to identify opportunity set. How do you know, and this is to answer the question, how would we be able to find the best if we do not know the rest, right? If to know the number one, I need to know the number two, number three, number four, number five, number six. If not, how would I know it's number one? So we do a lot of things. We look at industry context databases, manager visits, and all that. And after a while, you ask people around, you kind of know the rest, right? So it's a process of identifying the universe so that from the universe, you can find the best. So first of all, the whole universe. And the challenge of this is some managers report to the databases, some don't, right? And then some of the more interesting guys don't feel a need to advertise because they don't want to tell people their results. So there's a lot of really being in the industry, understanding the industry to be able to figure that out. Now, the next thing is, and I'll give you a number, we have currently about 1,365 unique funds in the database. How are you going to keep track of them, right? So you then have to put some sort of screen. And the way we have done it is we have negative screens and we have positive screens. The negative screen is that we generally want to avoid things that are risks that we cannot manage and tend to be critical in our experience, right? So let me give you an example. One of them, it would be some countries, the stock market is not very sophisticated enough. Then it is very difficult to do a hedge, right? So then you cannot hedge because hedging is very hard to borrow stock and sell, or the instruments are not there for hedging. So if you can't hedge, and this tends to be the less developed market and the smaller emerging markets. So if you say I'm going to buy a mid-cap stock in one of the ASEAN countries, and I'm going to borrow a stock to hedge, you have difficulty. And if you hedge through the index, that would be a mismatch. So there are some places you can't hedge. So we said, look, let's not even bother, right? Whereas if you went to invest in Japan, that's a very deep market, it's a developed market, you can easily borrow stock and you can easily hedge. So we avoid places that we believe that you can't execute the strategy. Another thing is we avoid markets where the regulations are a bit underdeveloped. In bad times, and the market's selling down, they say, sorry, it's illegal to short. Then all of a sudden you are exposed to the long and the market's going down, and that's not necessarily a great thing. A third example would be a market which not enough depth, right? For example, I gave the example, if you wanted to buy Singapore banks and all the Singapore banks move in the same direction, then there's no point in long and short because you're not going to make anything, right? You might as well just say, I like Singapore banks and go long. because the difference between the two banks are. So some of these considerations, if it doesn't work, we don't do it. Another two examples of the risk that we don't take, and this is more peculiar to Asia specifically, is we try not to invest in strategies that are too leveraged, because in periods of stress, the leverage goes away, and that's always a bad thing to be selling when your leverage is going away. And the second thing, we avoid strategies that, in our experience, can become illiquid in times of stress. One example will be high yield bonds in Asia, right? I've had the experience of investing through the Asian financial crisis, and I can see that when it's high yield, when it goes into a crisis, it becomes distressed, and then distress becomes illiquid. You can't get out, and then there's all sorts of things that go bad around that. So based on our experience, right, we can cull the strategies that we don't think are hedge fund strategies, and we focus on the ones that we can give the hedge fund strategies. That's a negative screen. On the positive screen, we obviously look at strategy and returns, right? I say there are some strategies we don't understand, we don't invest. Maybe we have a certain return expectation or a certain risk expectation, and then we put that in. So that comes out with a list of potential investments. Then we go into the manager selection, and there are two parts to that: investment due diligence and operational due diligence. I will go through that in detail in the next two slides, so I won't touch on it right now. But this is the part where we actually go and kick the tires with the manager and say whether can we invest in that or not. And then we go into portfolio construction, which is not that much different from any other portfolio construction you do. You look at the risk, you look at the liquidity, concentration, downside, and then you put that portfolio together. And then the monitoring, which is portfolio and manager review. So I'm going to really focus more on the manager selection side, which is probably a little bit different. Okay, investment due diligence. Investment due diligence here is all about understanding performance, right? You look at the numbers and you say, look, the numbers are fantastic, right? So what are the questions you want to ask? Is this a one-off or is it sustainable? Right? So you said if it's sustainable, then they have to have a way of doing it that is a certain process. And the process, again, allows the results to be repeatable and consistent. So we look at the investment process. How do you do things? How do you think about it? How do you do all these things? And we understand. So that gives us confidence that the performance numbers can be repeatable in a consistent fashion. The next thing we want to do is we look at the manager and the team. In order to, long and short, you need to understand the fundamentals, right? Do the people in the team have that experience? If you are hedging, do you know how to short? So we look at the team, we look at the experience level in the team and see that the experience level and the capabilities of a team match with the things that they need to do within their investment strategy. And the third thing, obviously, is the important thing. We look at the risk management. They need to have something in place so that when the market goes down 50, they don't go 50, and they have some ability to even go positive. So we look at these three broad areas, and that will give us a sense of what is behind the numbers. Now, a second element which we've added in is what I call the technical term is conviction level, but the easy way to explain it would be example like dating. When you meet somebody the first time, wow, fantastic, she looks great, he looks great, he's got a great job, he's got a good family, I like him. And he says all the right things. But that's the first time, right? And so what we say is, you got to meet the guy a second time, a third time, a fourth time, right? And then see that, the things that this person said in the first time is repeated in the second time and it come true. So that's where the conviction score is. So even though we went in there and we said, man, this guy's got a great track record, it's got a great process, it's got a great team, and it's got great risk management. But then we need to engage a few more time to validate ourselves. So that's a conviction source. So when we evaluate the manager, we tend to meet the manager many times. And if we're really, really lucky, we get to eat dinner with him and his wife. Okay, so this is on the investment side. Now go on to the next page. Okay, these I just wanted to flash very quickly, and I'm not going to go through in detail. Some of the sections in our due diligence report to what we have done, I'm not going to go through it in a lot of detail, right? So we look at analysis, standalone, we look at the attribution, and we look at the process and stuff like that. So let's go on to the next one, operational due diligence. So this is a little bit new that we tend to do, which is hedge funds tend to be got very flexible investment strategy. They tend to report every month, and so we need to really have a better understanding. And they tend to be smaller firms, right? So these are some of the things that we look at in terms of the operation, which is the company itself. How strong are their operation, and is there operation risk? Is there and very simple thing is there a problem in that they are generating their own valuation, right? Do they have independence valuation? Do they have independent governance? who can transfer money out of the fund? Can the manager create a small fund in Cayman Island run by them and then invest in, or a small company created by them and then have their fund investing in that company, and then the company goes to zero and the money disappears? So there's a lot of this governance, control of money and all that, right? And so this is all about it. And that's where we as financial institutions in Singapore have some benefits. Because we obviously are well regulated. So when we get a call that we need to look at cyber security, so then we go to the manager and say, "Excuse me, Mr. Manager, do you have cyber security protection? Right? Do you have PDPA? Right? Do you have insider trading?" So it's a lot of these regulations. We make sure that they are operationally sound and there's no operational problems. So there are two elements to this. The investment side is good and great, but we also spend quite a lot of time. And just to give you a sense, the way we are organized in our team, we actually have one person doing investment due diligence and one person just doing operational due diligence. And both of them got to kind of agree that before we make an investment decision. So that's typically a little bit different than the long only funds. Now the next one, again, I'll just flash this next page. I'll just flash you some of the things that we look at, right? Regulatory licensing, compliance, AML, internal controls, trade error. What's the system that they have? Do they have independence valuation of the entire book? If they tell us that they value themselves, then some part of it then we'll say, it's okay, thank you very much. That's really not where we're going to go. Data backup, if they get hacked, what's the problem, right? I need to understand that. So let's go to the next one because I don't want to spend too much time on this. Now, this portfolio construction, very quickly, there is a bit of a quality. It's a big mix of it, but the way we try to do it is there's a bit of a quality element, and then there's a quantitative element, and then we do some stress testing around it. So not going to spend too much time on this section. So let's move on next. Use of hedge funds. I guess this section here, I'm trying to think about it as you as an investor, what can hedge funds do for you, and how this can be beneficial to your portfolio. Why don't we move to the next channel? Okay, the first one is to access Asia with active risk management. So one of the things when we looked at the performance of Asia over the last, from 1995, we can see it's very volatile. So this makes investing in these places, a buy and hold strategy becomes quite difficult, right? So let's say you bought at the peak of November 07, and then you lost 50%, and you're wondering what the heck happened, right? So if you can manage that risk, then you can outperform. And it is precisely this that I bring you back to the performance numbers earlier, why Asia outperformed, right? If you don't drop by 56%, and then you get your share of the going up over the longer term, you actually make more money. So, right? So for places where there's this huge volatility, your ability to manage the downside will ensure that over the longer term, you generate more money. Next one. Now, from a diversification perspective, right, and those of us who have done finance understand Markowitz, that there is benefit in terms of diversification. And we have done some quick analysis to say that, if you start with a global portfolio, which is that bubble on the bottom, your return is 5.79, vol of 8.98. If you added 20% of Asian hedge funds, the returns would be better and the vols would drop. So there is an improvement in your portfolio just by adding in some hedge funds, right? Which was the original thesis of the investment, and that's because there is a low beta within against other asset classes. Let's move on to the third one. And the third one is just that, if you were investing in hedge funds in Asia, there is just a lot more inefficiencies in Asia. Right? Markets are volatile. It's difficult to cover. There are a lot of language differences, and it's just a more inefficient place. Right? So for those of us who are investing, let's say, okay, I already have invested in a hedge fund portfolio. I have a global portfolio. Why should I look at Asian hedge funds? And basically, that there is better returns in Asian hedge funds. So I think three broad purposes depending on your starting point. If you're an investor in hedge funds, number one, if you just want to have absolute return, then you of course want to invest in a hedge fund, right? Because then you don't have to think very hard. Should I be long? Should I be short? No, I just invest in the fund. I go and get on with the rest of my life, and my fund does the right thing because my fund is focused on not losing money for me, which is kind of what I want to do with my investment portfolio, and I can live the life I live. Second thing, if I was doing allocation and I wanted to invest in Asia, it's a very volatile market. Hedge funds allow me to profit in this volatile market. Third thing, I'm doing a very global portfolio. I have asset allocation of every sort. Adding it improves my risk return profile. And fourthly, if I run a global hedge fund portfolio, I should add in Asia because there's greater alpha. And with that, I come to my last slide. hope. Okay, great. Now, a last word again, I just want to highlight very much that, investors in hedge funds, it's good and great and easy. There are all these benefits, but really this dispersion and return is really, really important. And this is where I would give a bit of a caution statement that you really need to understand what is it you're investing, because the managers have a lot of flexibility. And it's not so homogeneous as it is in the long only side. The difference between the top fund and the bottom fund is a big number, big number, right? And so I would say, if you are starting out with this, find a way to be selective or work with somebody who can help you to do the selection, and try to maybe start with a diversified portfolio, because if you choose one and you're unlucky with the wrong one, then life would not be so great for you. With that, I end my presentation. Back to you, Cheryl.
Thanks so much, Han Seng, for the comprehensive presentation on what hedge funds are. Whilst we wait for questions to come in on the live, from the live audience, maybe let's start off with some questions that's come through the registration. Right. So how do you, as an asset allocator, assess risk versus reward for different hedge funds when trading styles vary so widely? So this is especially true for multi-strategy funds, where the strategy could be very opaque. What matrices do you use? Do you adjust for outliers?
I think for us, right, the key thing we use in terms of evaluating a lot of strategies is really, we want to understand the strategy very well, right? How does this guy make money? What does he do, right? And all of those things. For us, if we can't understand what they're doing, we don't invest. Right? Because we serve a lot of institutional investors, and institutional wants to explain. The other thing is that if I don't actually know what he's doing, I don't have a way of managing my risk, right? How do I know if he's actually faking the numbers when he's showing a positive return? But if I know, right, that this guy is roughly a bit long bias trading China, so if China go down, he should be negative. If he shows me a positive, I can have a call and say, excuse me, sir, can you tell me why you are doing this thing? So number one is, for us, it is very important for us that each and every hedge fund that we invest in, we understand what they are doing, we understand their sources of return, and we understand their sources of risk, right? And if they're doing equities, they're doing bonds, then we break it down, then we will compare them against peers, right? Or the broad benchmark. Why? If you're saying you're doing the same thing as this guy, but your return is 10 times better than this guy, then what is it exactly? So we do spend a lot of time, right? I mentioned this whole thing about dating thing, and we spend a lot of time dating, unfortunately. Not a lot of time dating the wrong people, but different people, but a lot of time with the same person. So we spend a lot of time understanding this. And then with that, and then as I said, once you break it down, right, equity, bonds and all that, then you understand the risk and you throw in the leverage. So when you break it to that level, then you understand the risk a little bit more. But I think for us, there is no shortcut to breaking down. So you just say, okay, it's multi-strategy. No, let's break it down. What is it, how you are doing, and how you're switching between the asset classes.
Yeah. So how would you say an entry-level investor, or one that's new to hedge funds, should pick a fund to invest in? And I know you touched a bit on this, yes, the last couple of slides, but maybe a bit more elaboration or clarification for our investors.
Two key points. I would say that we've shared with you what are some of the considerations. If you think that you have the ability to do it, good and great. If you don't think you have an ability to do it, then I think you should find a professional to do this for you. The second thing is diversification, right? Even for professionals like us who's been doing a lot of time, there's always a risk that something goes wrong. I mean, you look at all the cases that we showed you about all the challenges and all the blow up, right? Behind all of these are many very sophisticated investors who also do a lot of diligence. So even if these sophisticated investors can make the mistake, then what more of a beginner? So I would say the first thing is, if you are starting out, to look for someone who can help you with this work, and to have a diversified portfolio within your investment mandate. Now, then later on, you spend a lot of time with the person who's helping you with all of these things to try and understand what's happening, right? And when you finally find a strategy that you understand very well, then you can say, okay, you found for me 10 funds in my portfolio. This 1, 2, 3 I really like, I really understand very well. I want to invest directly. That's fine. So that's the way I would propose that investors access this as a class, as a beginner.
Okay. maybe further to that, a comment that just came in from the Q&A screen, if we're focusing on absolute returns, which is what we've been looking at in the last couple of slides, only 4 of the top 10 funds actually showed positive performance year to date. So, what do you say to that? I mean, is it just this year that is an outlier? How would you convince somebody who's looking at hedge funds for the first time to think about this asset class?
Okay. I think the right way to answer this is at the end of the day, right? There's somebody behind who's making an investment decision, and we believe that person who makes that investment decision actually based on data and fundamental and a certain thing. There are things that happen in this world where it is very difficult to predict in advance, and these can have implications on your investments, right? You can say that, hey, a lot of these things happening in the US on interest rate have nothing to do with Singapore. Why is my Singaporean stock dropping, right? Because interest rates going up, there could be a recession in the US, and all of a sudden the whole world is affected. So sometimes, and you may be really good at identifying stocks, but there are things happening, right? And then sometimes there's volatility. So I think the reality is when there is a certain reaction time. So it is very hard to say that somebody is always going to be positive all the time, at every instant. And I think it is fair to say that there has been a lot of things that are quite unexpected happening over the last maybe 12 months. I mean, the whole policy change in China, who would have anticipated how far it would have gone? Who would have anticipated? And then when things looked like it was going to be all right, then we had this special operation in Europe. And then we had this whole Fed thing, there's the whole low interest rate regime is going. So some people get it and are positioned there, some don't. And we're looking at some broad. So I would say that in the short term, they can be here and there, but that doesn't detract from the fact that these managers are actually trying to achieve a positive return. Now, generally, and what we have seen in the past is that if you look at it over a long enough time cycle, they tend to come back. So I would say that if you give yourself enough time, it tends to come back, and that has been our experience over time. That we cannot guarantee that there won't be any drawdown, but the good hedge fund managers will try and figure out, will understand, because the volatility tends to strike in a certain time. Then over a longer term, it tends to be driven by fundamental. Or after a while, people kind of figure out what the game is, right? What the Fed is doing, they kind of understand it. So then they will come back again. So I think if you're looking at it in longer term, the promise is there. But if you say I want to be positive every day, every month, then I think it is not really a realistic expectation. And if that's what you're looking for, then maybe you need to find someone else, another asset class of some sort. I don't know.
So then, speaking about fitting hedge funds into a portfolio, how big of an allocation do you think would suit maybe an entry-level investor versus somebody who is more mature in their investing? What kind of allocation relative to other alternative asset classes?
That's really, I think, your portfolio should be, I think, there are many ways of looking at it, but the way I look at it is up to your comfort level, right? You shouldn't really invest in things that you don't understand. If you look at some of the more institutional investors that invest in alternatives, and some of them are very illiquid, private equity are 10-year longs, right? So I guess you need to have an investment portfolio that you don't want to touch for 10 years. If you want to touch it for 10 years, then don't do a private equity. Typically for alternatives, look at the endowment, they go 30-40% to some extent. But I would say a good starting point, if you want to look at hedge funds, is to maybe look at starting at 5% or 10%. Again, it depends on the size, right, of your portfolio. But 5, get to know it, see how it's comfortable, how it works, and then you can decide. And hedge funds generally are illiquid, but not that illiquid. You can redeem generally every month. So it's fine. So I would say maybe the direct answer would be go between 5 to 10.
So would you then have a favorite or a few favorite hedge fund strategies that have worked for you? Why do you like these?
Let me clarify some context on my answer, right? So you understand a little bit more. We have spent all our time investing in Asian hedge funds. And the one reason why we have focused more on Asian hedge funds rather than global hedge funds is the element of operational due diligence, right? We really need to be able to go there, look at them in the face, and then kick the tires, visit the office, see the operation, talk to the operation people, see that the operation person actually understand what they're doing, see the system, look at their manuals. They said everything goes from A to B to C to D, and then we said, okay, can you take out all your paper to show that it actually went from A to B to C to D. So in our process, we try to visit the managers very regularly. We want to see things happening, and we find it very difficult to do that for managers that are far away. Right? Now, if you look at Asia, then the predominance of strategy that we look at is equity long short. Because a lot of the managers here, a lot of the hedge fund managers tend to be from the long only side, right? And they tend to be a lot of equities. So we do a lot of equities. And the good thing about equities is so everybody understands equities. So the risk of a valuation error or a fraud is much reduced. We do macro as well. To a certain extent where it's predictable, then we do macro strategy. So interest rates, FX, and all that, we look at that a little bit, and we like that. That has a way of diversifying. Sometimes, like, US dollar, if you were in US dollars, life would be great if interest rates. We do less of credit in Asia, primarily because I think we find that the returns from credit are a little bit low for us. As I mentioned to you later, for risk control reasons, we don't do a lot of high yield. And when we do the investment grade, then the returns are a bit low for us. And for hedge funds, the diversification benefits of bonds with equity is not that great. So the bulk of what we do are really on the equity side and really the macro strategies. And of course, multi-strategy, a combination of both of those two things. And so we like those.
So knowing Asia as well as you do, what is your view on China's economic recovery? Specifically, is there any light at the end of the tunnel for property developers?
There's always light at the end of the tunnel. It's just whether it's the end of the tunnel or the oncoming train. Okay, let me share this view with you, right? And I attended a webinar recently where the guy who said that if he can answer this question properly, he wouldn't be in a webinar, he would be borrowing money from the bank, investing in that, and becoming a millionaire at the end of it. So take this with a pinch of salt. I don't have a sense of what's going forward because there are a couple of things that are driven by politics to some extent, right? When will the COVID situation end? What does common prosperity look like in implementation? How will the geopolitics and situation kind of work out? I don't have a good sense of that at this point. What I do know is if you look at the longer term, and no matter what kind of outcome you have of deglobalization or whatever it is, China is a big country, 1 billion people. They have a large middle class, and they will continue to do their thing. And common prosperity or whatever else, there will be industries that benefit, and there will be industries that don't benefit. And as far as we're concerned, we just buy the guys that do well and sell the guys that don't do well, and they've got a very big stock market in terms of the Asia market, right? So you can't ignore a country like China, 1 billion people with the size. I mean, their economy is very, very large. So from my point of view, you can't ignore China. So you've got to be there. Then next question is it now? Right? If you don't know when is it, then the question is it cheap enough such that if you go in now, the risk of a downside is less than the risk of an upside? Well, there's quite a lot of bad news in China already, right? We can give everybody a list today. And if you look at the valuations broadly, we are about as low as we can get over the last, since maybe the GFC. So even if you go down now, the odds are on your side that going up is better than going down. Okay? So from that perspective, if I go in now, I should be in. And if I go in now, my risk is not that high because it's been correcting for so long. So I think you should do it. Now, I add another element to it, right? The risk for you is really more for timing. Things could go a little bit worse. So investing in a hedge fund actually is the right way of doing it, right? As you would expect, this is my model answer, right? So you have an exposure, and if things go pear-shaped in the short term, you actually manage that a little bit. But when it goes up, you have an exposure and the managers can go there. And some of these managers, and so you got to pick a few managers who have a bit of a profile of managing the risk, but if the market would go up, then they have the very ability to then switch very quickly and move forward to that. Or are already positioned in, who have a good insight and understand that, okay, this is how the China of the future is going to be. I've read everything, I understand this is what the government wants to do, and I'm already investing in the best companies in this area. Right? So I think you should start going in that way, but the hedge funds give you the risk management if you are a little bit worried that you might have a bit of a drawdown in the short term.
So further to that, one of our investors is asking, with their zero COVID regulations, how would you then go about with hedging, with evaluating investments in China, and with doing your due diligence?
Your investors have very good questions, which I have to think. I would say, yes, it is a little bit difficult right now. So we are a little bit cautious about investing in managers that are a little bit smaller and a bit new, right? So we have tended to look at the larger managers, and there are some places that we can visit already. There are some that we still have to rely on Zoom, and also rely on the fact that we do have local offices in some of these countries which can help us to do a few things. The second part of the response is, I think over the last 2 years, we have learned to be very comfortable using Zoom and other forms of due diligence through video. And so we have enhanced that, and to some extent, we have got some level of comfort to that. So through the use of technology and adapting to this time, and actually slowing down our deployment to new and smaller managers, which are a little bit more risk, we've been able to adapt. But obviously, we're looking forward very much to being able to travel freely to these countries.
And when that happens, do you think UOB Asset Management will look beyond Asia to the rest of the world, look globally at hedge funds there, or would you still think that you keep to the Asian hedge funds predominantly?
If it was left to me, I think we would really focus on Asia. We do like Asia a lot, and we do think that Asia is a place we understand well. And the key to us to making money and managing our risk is knowing exactly what's happening. So as you know, in UOB Asset Management, we not only do hedge funds, we also do equity asset classes and bond asset classes. And we have offices across the region in many of these countries. So this gives us a lot of insight, right? We talk to our colleagues who are working in China, who are working in ASEAN. So we have a good sense of what's good, what's no good. And so that's an edge. If you ask me, do I know what are in a great deal of detail, what's really exciting happening in the US, not maybe as good as somebody else. So we have a good understanding here, and we have shown already that Asian hedge funds have the ability to generate significant outperformance from Asian ETF. So if you invest in this, you can make a lot of returns. Number two, the alpha sources, there is increased alpha. It's less competitive, there are less hedge funds, and it's a very volatile market. So the data shows that you can make very strong returns versus the listed. There are good alpha opportunities, and we have an edge to execute on that. And there are, as I mentioned, the database of 1,300 and how many funds. So we still need to figure that out, right? So there's a lot of work we do, and we feel that this is where we have an edge, and we will continue to focus to do this.
There's enough out here in Asia for you to look at.
We don't have to do everything. We just need to do a few things really well.
Yes.
Yeah.
Well said. So maybe moving on to a different type of question. We had one from an investor asking about fees. So he's saying that he's not entirely convinced about hedge funds being right for his portfolio because there are many layers. I think that means the management fees, the performance fees. Is there anything you can say to change investors' minds, people who think like this?
The only thing I can say is that when I showed you the performance numbers of Asian hedge funds versus equity fund, these are generally these are performance net of fees. So the numbers speak for themselves, right? I mean, some things are expensive, but so this is the other challenge of hedge funds, right? Everybody charges the same fees, but who's good, right? So it's again selectivity, right? Everybody charges the same. So again, everybody charges the same fees, and it's important for you if you cannot have an ability to negotiate the fees, then you should make the fees worth it and find someone that's good. So selectivity. So it's been our experience that we have been able to put together a portfolio that has managed to outperform the Asian indices, even with the fees we managed to pay. So I guess this is my only response. I think if those if you just feel very uncomfortable with paying high fees as an absolute concept, then yeah, that's tough. Right.
Yes. So again, for beginners, which some of our investors are, can you give people some tips on resources? How would they go out in the whole universe of Asian hedge funds and look for the ones that could be suitable for them? Is there any analysis that's available publicly for investors?
There are a lot of information services. You can subscribe to databases, and they'll give you the information. The challenge for you is really the diversity, right? And knowing it. So, for example, I mean, if you were investing in Asia, right, you speak to a Chinese manager and he's based in Beijing, right? How do you know he's really set up there? I mean, Zoom is good and great, right? You can do a little bit of that, but you need to figure out who is his friend, right? Because the people know the industry, right? To diligence manager A, I need to talk to manager B, manager C, manager D. I need to talk to the people who is invested in manager A, and I need to maybe go around the neighborhood and ask the people around the area, right? So that's the part that's difficult to do, right? The desk-bound part, you're losing a lot of the elements of that going down the ground, as we feel that's important, and that's why we continue to be focused in Asia. So I would say that if you were depending on your resources, right? If you had the resources and you could do it, good and great. But if not, then I think the challenge for you is there's quite a lot of things. It's a big region. Many managers are based across, and some of the best, how should I put it? Some of the best managers are not going to come to your office and ask you for money, right? You have to go in there and say, can I give you money? And so if you're sitting here and nobody tells you that he's good, then you have a problem. And generally the guys who come to you and ask you for money tend to require a little bit more analysis. Yeah. Okay.
So, I'm not sure if you can share, what are some of the top hedge funds you have identified? If you can share some names, or you can share some more specific types, and why would you consider these top hedge funds across the many years that you've been investing?
Sharing names would be difficult for, I believe, compliance reasons. Because I'd be marketing somebody's funds. So I would say maybe we, if you really want to know about funds, then you know where I am. Come and look for me, and we'll have a conversation, and we can talk till the cows come home, because I have a real passion on this thing. But broadly speaking, we have been, and I can show you at some point in time, we have found managers that have been able to generate consistent positive return over the last few years, market up, market down, right? I think good. Let me just, a couple of attributes. These are good funds. Attributes of these funds generally, right? Generally, we found that we like funds that are generally smaller. We like people who are passionate about what they're doing. And we also like people who have, simple, right? Experience, focus, alignment. If the guy is prepared to put his money in, sell his house and put his money in, but more importantly, his father-in-law also put money in his fund. That's really good. Those that I'm the best guy in the world, but my wife doesn't want to put any money. My father-in-law not interested. My mother doesn't want to put money. Then it's okay. That's fine, right? So there are some of these things: alignment of interest, someone who has a lot of experience, and then prepared to be very transparent, because that shows the confidence, right? Tell me what you're doing, what we're doing. And then that's what we time. Those that I'm really good, but I can't tell you anything. I'm highly secret. I'm the best, but can't tell you. Those are difficult.
Yes.
Yeah.
So we've only got a few minutes left, but
Sure.
Maybe there's a very good question here that's come on the Zoom. What is your view on ESG considerations when you're selecting hedge funds as managers? Is there a theme that you see actually growing in this space? What specific strategy do you think can grow from this that would be of interest to investors?
We look at ESG from two perspectives. Number one is that you invest based on ESG itself, right? You buy the ones that are good ESG and the ones that are negative ESG. It's kind of a long shot. And the other one is that they, as a firm, they have some good ESG practices in the firm, right? When we invest nowadays, we do ask our managers as to how they do these things. And I would say in the hedge fund world, when you say, let's go long the ones with good ESG and let's short the ones with bad ESG, that is still a very nascent space. It's very hard to find managers who have done that by and large. But if you say as a firm, they want to embrace ESG and they're embarking on a journey to implement it when it makes sense, then I think we're increasingly seeing more and more of that. So the answer to it is yes, we are talking and engaging with them. There are some managers that reached out to us and say, hey, we want to do all of these things. Is it important? How would we do it? And we said, look, UOB, we have done all of these things. Let me explain to you as a firm. And then you evaluate over time whether this works or not. So I think we communicate to them it's important, and we communicate to them that it's something that they want to look at and begin the journey. But as to actual strategies that are investing purely on ESG considerations, the number of funds are still too small for us to be able to select the best, right? You need to know a big universe to be able to select the rest.
Sure.
Yeah.
Thanks so much. I think that's all the time that we've had for today. And I know there's some questions that didn't get answered. So we'll try to answer these for you offline. If there are any other questions, please send them across to graceong@addx.co. Thanks so much, Han Seng. It was lovely to have you in the studio and to talk about hedge funds with us today.
Thank you very much, Sarah, and thank you everybody for joining us this evening.